Very good afternoon, everyone, and thank you so much for joining our call. Call is going to be about equity outlook and what Axis thinks about going to happen again. If you look at the market following 4 months of consistent positive returns, Indian equity last month retreated on the back of a relatively weak FPI flows and a higher yield on US Treasury. If I look at the BC, Sensex, and Nifty 50 last month, they were both down by 2.5% each. Whereas if I look at the mid cap 100 and the small cap 100 index, they continued to outperform their large cap peers. They were up by 2.7% and 4.6% respectively. So why did that happen? And what is our outlook for that? We have Mr. Ashish Naik with us. He's a senior fund manager with Axis. So Ashish, over to you.
Thank you so much, Shikha. So just like to share the presentation that we are going to run through briefly. So yes, I mean, absolutely right. As Shikha pointed out, we have had a period of extreme returns in the market where the large cap indices, which have been actually on a roll for the last few months, actually took a breather, down about 2.5%. In line, if one can say, with what has been happening globally, but on the other side, the mid and small caps were still on a tear, partly probably driven by flows. As we can see, domestic flows have been extremely strong even during the month compared to even FII flows. In terms of external trade trends, rupee has depreciated slightly given the flows. Brent oil, etc., has also been slightly higher. There is some bit of demand supply mismatch there, and gold has been largely flat. If we go slightly deeper now, and that's where India and probably a market like Japan has stood out versus the relatively much more developed markets, US and Europe. If we look at the returns that have been generated in most of these markets like US, Europe, it has been much more concentrated towards the largest companies, what we call as a narrow market. But on the other side, India as well as Japan has seen a much more broad-based returns profile, where the index returns are still higher than the large cap 15 names. Clearly shows that this is where the mid and small caps have contributed to these markets. Going forward into how the economy has been doing, and which is where a large part of the return story and the growth story of India has picked up, one can clearly see that fixed capital formation, which means other than consumption part of the economy, which is investment led part of the economy, has been relatively stronger in the last few months. And that's actually resulted into India still retaining the tag of the fastest large growing economy in the world. In addition, if we look at how the overall growth has been in the corporate India, so moving from, let's say, the macro to the micro, one can clearly see that it is not just driven by just GDP growth, top line, which is the sales of companies, but it is also actually how the profits of these companies have grown, and which is where we can see both the Nifty and Nifty 500 companies, the growth in the PAT, which is the profit after tax, has actually been much faster, and that is because the margins of various companies, which we measure by the EBITDA, has actually grown. There are a few sectors such as IT, maybe cement, chemicals, metals, probably a lot of commodity names here, have actually seen some bit of weaker results. Obviously, that is also because global economy has been slightly weaker. We have not seen as much demand growth from China. And that is where these global demand constraints have resulted in some bit of slowdown there. But any and most of the sectors which are related to the domestic economy, including banking, autos, etc., we've seen much better results. In fact, many of them have actually shown a beat to the market estimates overall. Coming to the slightly not so great part of the economy in terms of rural, while we saw, let's say, last year, rainfall was much better from an overall perspective. Last 5 years, if we look at, we have seen a decent amount of rainfall. So the chart here on the left, which is showing the cumulative rainfall as of September, clearly shows that the overall rainfall was much better. This year, we have seen it to be very, very erratic. June was a relatively low rainfall month. July actually caught up and actually was one of the highest rainfall months in many years. And again, August was the exact opposite, where we could see that there were deficits across the board. Obviously, this is not a great sign. And we have seen some bit of stress because of that across various companies that report in this field who have agrochemical, etc. And their June numbers were actually not that great. But there is still hope that if September is a decent month, we could have a decent season for this year. Given the fact that we have had 3-4 good monsoons before this, the overall reservoir levels are not extremely under stress. And in addition to that, if September is actually a decent month, we could probably see a much better Rabi season, because last year Rabi was actually weaker comparatively. Another important factor, which obviously we need to look at when we talk about monsoons and rains, is about inflation, and which is where the economy actually gets impacted much more in terms of food inflation. Yes, that is one thing that is RBI is also worried about. Food inflation can be a cause of concern because it's a much bigger basket, a part of our consumption basket today. And to that extent, government is extremely vigilant. They have been making sure that there are right amount of policy measures done in terms of exports and as well as allowing imports of various commodities. So clearly that's something as a very high priority for the government to keep food inflation under control. Coming to overall, if you look at how the CPI has moved, we have seen a decent amount of moderation on the core CPI. That's something which is giving us a lot of comfort. Global CPI itself has been on a downtrend after the huge increase that we saw due to the geopolitical crisis in Europe last year, as well as supply constraint from China. As we have seen from the start of this year, as China has come out of their COVID constraints, supply has become quite easy, and as such, demand has also not been that much of a pressure. To that extent, inflation remains to be under control. Overall, if one has to look at it's a positive thing, given that a lot of global central banks are actually in the tightening mode still, and inflation is one of the biggest priorities for them for the last 12 to 18 months. So just looking ahead from here on, and obviously one can see in a scenario where most of the developed world is still under stress because of high interest rates, probably looking at a potential recession for a few quarters, China not picking up. It's a scenario where India actually stands out quite easily as one of the fastest growing economy in the world. And that's where we have seen high PMI numbers, which is basically manufacturing index for India, showing that that actually has been in expansionary mode for a long time. Even there, we can see that a lot of positive things from a micro standpoint, which is basically improving of balance sheets of companies, which means they have very low debt, which was one of the biggest worries if you look at, let's say, last decade, and especially the early part of the last decade, where companies were laden with a lot of debt. They had put out capacity, huge capacities in sectors such as cement, infrastructure, power, and also there were a lot of issues on working capital for companies in various sectors such as road construction. A lot of these issues have been resolved. The banks have been able to resolve their asset quality, which was under a lot of stress. And today we are in one of the best asset quality cycles that is there for the banking sector. So both from availability of debt as well as supply of potential corporate loans, both of these things are actually looking quite positive at this point of time. The next part is obviously what we can see in the numbers. If we look at the time between 2003 to 2008, was about 12% of high ROCs that these companies had. But today, in terms of ROC, which is the return on capital employed, for most company, for on an average, for these companies is at about 16%. So clearly, one can see that there is a high level of profitability that is embedded into Indian companies today. And also this is without taking too much of leverage. So hence there is a even more chance for these companies to now grow faster by taking some bit of leverage, some bit of debt, and hence putting up new capacities and trying to grow their businesses faster. So how does this, just to put it in perspective, when we say that deleveraging, which is lower debt levels for companies, which means they are able to generate high level of cash flows, they don't have to pay a lot of interest, and as well as their margins are good. Two ways to go that it can go into. One, if they find opportunities to grow, they can put new capex, new capacities, new plants and infrastructure, and hence as well as wherever they can find good ROC, or what we call as ROC accretive businesses opportunities. That's where the identifying those companies becomes important. Probably a lot of these will be into cyclical sectors where such opportunities can be easily found. The other is, if companies are growing at a stable rate but they are still able to generate good cash flows, then they can look at adding more and more dividends, probably looking at more and more buybacks. And this is also a phenomenon we have seen across many sectors such as IT and various other sectors, where slowly and gradually, where companies have matured to a certain level of growth and probably are looking at stable growth from here on, but are generating huge cash flows, are coming out with more and more dividend payout policies as well as regular buybacks, which means the ultimate investor, the minority investors, are able to reap the benefits of investing into equities in terms of regular cash flows. The other part is now, if we look at reforms, and obviously private capex is something, as we discussed last decade, was missing. So if we look at how our GDP has grown in large part of this century, the first decade was probably more of B2B. We had a lot of investments happening in infrastructure. The last decade, which is 2010 to about 2020-21, most of it was driven by consumption. Investments were much lower as part of the overall GDP. This decade, we can see that while consumption will still continue, we still are growing in terms of our demographics. There is a lot of urbanization and other such phenomenon which are resulting into higher consumption growth. But the investment, which is driven by capex, by companies, investment by various private companies, is also going to be a big portion. And we are seeing initial signs of that in the last 2-3 years. Obviously, things like COVID delayed this cycle by maybe a year or two, but now this is actually picking up much faster. So just showing how supply side investment. So why would companies put up capacities? The simple answer for that is, you can see how these companies, let's say industries like cement, for example, is seeing its utilizations grow more and more. Probably back in FY21, 2 years back, this industry was at about 64% utilization, which means they had a lot of free capacities with them. Today, this level has come to about 72-73%. As soon as it reaches 75 or maybe even 80%, even for a few months, companies have to think of and start putting up new capacities. And that's where we are seeing a lot of announcements by this industry of putting new capacities across various bigger players. Similarly, another big industry which has seen a huge investments is the power industry. But what we have seen is a lot of these investments in the recent years has been into renewable part of the economy, renewable part of the overall sector, which is solar, wind, etc. But a lot of investments now need to also go into the traditional part of power, and hence there we can see that the PLFs are already reaching peak levels of what we have seen back in 2008, and that means another investment cycle is imminent there. So one thing which is, a lot of people probably miss out is on how to look at growth versus value. And we've given two examples here of companies in two very different industries in each of these categories. One is a retail and BFC. The other is one of the prominent chemical manufacturer. Both of these have been trading, if you look at their 2021 valuations, at a much higher premium compared to the other two in the FMCG as well as utility provider, both on price to book and price to earnings. Today, if we look at how these companies are trading at, a lot of the gap on the price to book as well as the price to earnings of these companies have narrowed in terms of their premium to the value companies. On the other side, if we look at the performance of EPS, which means the earnings per share or profit growth for 2 years, for both these companies, and the growth category has been much faster and higher. But having said that, the valuation premium has come down. To that extent, one can clearly see that in such a scenario where interest rates are higher, which is what has been the case for the last 18 to 24 months, we can see that market has been valuing stable cash flows versus growth higher, and hence the valuation gap between growth versus value has come down. So just moving forward, this valuation argument, which is one of the very important arguments for India, is probably one of the most expensive markets in the world in terms of market valuations. But if we go down and drill down on the numbers of on the businesses out here, one can clearly see that both on ROE as well as earnings growth, India probably stands out as one of the fastest growing economies. We are at the ROE level of 15% plus, as well as the EPS levels are more than 20% on a CAGR basis. As well as one can see that if we do even as a profit as a percentage of GDP, we have still not reached to the levels that we can potentially reach to. We've probably gone from 2 to 4%, but the potential is to go to 8% of GDP. So to that extent, profitability of Indian companies can still keep growing from here on. And hence, we believe that while there is a premium that India always enjoys versus global markets, and that premium has gone up, it's largely because global markets have probably slowed down in terms of their economy as well as their businesses, while India still shows a spark of growth. Just drilling down this a bit further into how the markets look like. And here, most important chart is the green, which is the mid-cap premium versus the large caps. A lot of people think that mid-caps have run up. And yes, obviously they have run up. And there has been a huge amount of rally that we have seen, especially in the mid-cap names. But obviously, these are the fastest growing part of the overall markets. One can see that if a small cap actually grows much faster, over maybe a few years, 3, 4, 5 years, it starts becoming a mid cap, and hence that is the portion of the market which actually has high growth. But these companies are yet not reached to the level where they have become a large cap and probably at a stable level of growth, and hence the valuations for these companies still remain much higher, especially in an expansionary cycle that we are into. So we can see, as we have seen in the past, such kind of premium for mid caps versus large caps, which is there today, can continue. And having said that, this premium has actually come down from the earlier peak levels, and it can be stable at this level as long as mid cap companies across various sectors can keep showing consistent growth. What will be important to see here is one should not get trapped into companies that have benefited because of raw material prices and hence have shown some near-term high prices or high earnings growth. But what we need is companies that can continuously grow at a much faster growth rate, let's say from a 3 to 5 year perspective. Now coming to the challenges, and obviously this is one of the biggest challenge that is there for an import-driven, commodity import-driven economy like India, where crude which is basically the basic source for energy for our economy, remains we remain dependent on imports for this. Last year was one of the probably most difficult times for our economy as the crude prices went up. Thankfully, we were able to procure a decent supply at relatively reasonable prices, and to that extent, the inflation levels did not go as high as they went into other parts of the world. But today we are again seeing that from July onwards, slowly crude has started inching up. And to that extent, it is, while it still remains in our comfort zone, which is probably nearer to $80 or maybe $90, but anything above $100 of crude will actually impact our inflation levels as well as the expansionary cycle that we are seeing. The central bank remains extremely vigilant about inflation levels, and once they cross their comfort zone, they will not hesitate to increase rates. At this point of time, this does not seem to be a big worry, but one needs to always keep a watch on if any event such as what happened last year could result into higher energy prices for India. Another big challenge, and obviously this is very important for any democratic countries, which is basically elections every 5 years, can result into some changes in the political environment, which means obviously policies from the government can become or can change the course that have been put up by the earlier regime. To that extent, as long as there is political stability, people people and the markets will actually be more comfortable giving India the valuation premium that it has, especially from a foreign investor perspective. This becomes extremely important. And this is not just investors who are putting money into the equity markets, but also the longer term money, which is called as the FDI, the direct investments that come into India, both from a debt and equity perspective, will look at continuous continuity into policy front, and hence that is very important from overall economic perspective. Having said that, markets have reacted to these events if there is a discontinuity in the overall regime, and to that extent, which is something that we need to keep a watch on from, let's say, a 10-month perspective. So just moving from here on, we have talked about the markets, we've talked about the economy and some of the challenges. Just a brief on how Axis looks at positioning their portfolios. If you have attended any of our earlier presentations, I'm sure you would have heard that Axis believes in terms of investing into businesses that are able to generate long-term returns. Some of the core philosophies that we have of investing and identifying businesses have been laid out here. We'll probably not go into too much of details at this point of time, but just to emphasize here, we try to identify business and business strategies and business models that are durable, that have competitive strengths and a long-term track record of management as well as the overall promoters. Some of the things that we also like is lower level of competition because of some entry barriers, which means if the competition levels are lower, the players that are there can have better pricing power. And then, yes, this is it's also important that while there is a decent business model as well as environment, is there a right kind of management team that can execute with the right kind of talent, as well as, obviously, very important part of it is governance standards. A lot of times have not having governance standards can result into a good business going into shambles. So clearly that is important part of our decision making. And then finally it comes down to the numbers, where we look at balance sheet, leverage, etc., which is also a result of what we have seen on the top. So yes, this is how we analyze businesses. We have expertise and experience into the team who have been looking at various sectors for many years, and also managing these sort of businesses and companies, so they are able to sort of analyze and come out with the right kind of mix of businesses to invest into. Risk management is also an important part of this. Anything that we do, at the end of the day, for us, investing and returns are always versus the risk that we are taking, and hence risk management is embedded into our investment decision making process. I'll not go into this much more into detail, but suffice to say, between 2019 and 2023, what we have seen as an economy, as we said, we have moved away from not being only a consumption largely driven economy to an economy which is driven by consumption as well as investments. And that means there are a huge amount of opportunities that have opened up. And hence, while our portfolios carried much lesser number of sectors as well as stocks, today, we have many more unique sectors as well as stocks that are there across our large cap, which is our blue chip, to our flexi cap, as well as our mid and small cap funds. So clearly it shows that market has broad-based. There are many more opportunities that have been generated and that are being generated across various sectors, and we are trying to invest and identify into them in terms of across our funds. The four themes that we will emphasize from here on is, while we have seen post-COVID consumption in the urban part of the economy picked up faster, rural recovery has been relatively slower. So as long as we discussed at start of this call, as long as monsoons remain decent, we can probably see that rural economy can slowly and gradually pick up from here on and actually contribute much more to the overall GDP growth. So there will be opportunities to look at here, and which is where sectors such as FMCG, auto ancillaries can be under focus. The other part is capex cycle, which is what we said, from consumption to investments. Good balance sheets of businesses results, and as well as banks having good asset quality means that there is a decent potential for the new private capex cycle to pick up, and that's where things like construction, real estate, as well as some PLI, etc., driven strategies, PLI driven sectors such as chemicals, semiconductors, renewables, all those kind of sectors can kind of pick up from here on. One thing in terms of risk is margins. As we have seen, low raw material prices have resulted into many companies showing very high growth in profits. But if they cannot sustain their overall margin levels, as whenever raw material prices pick up, then there can be some pressure on these businesses. The other part is even a sector such as finance, which is banks, especially if interest rates start coming down from here on, will many of these banks be able to maintain the high net interest margins that they've been able to generate for the last couple of years? If not, there can be a slowdown there. As well as there are various other commodity companies, commodity linked companies, which also need to be watched out for this. The last is obviously flows, and we have seen that FII flows have been quite erratic in the last 2 years, where there was a huge outflow as interest rates started going up. Emerging market funds especially took out a lot of money from the overall markets. From here on, as interest rates have peaked out, once they start gradually coming down, will they probably look at India as one of the high growth markets and come back? We also have to see how the domestic investors behave. We have seen a very high level of interest from the domestic investors in the last few years, especially post COVID, and continuity of that will also be important from the overall market perspective. So there's this summary. From a macro perspective, we are saying that India should continue seeing FDI flows. There are also geopolitical reasons for this. China plus one, where people want to move away from China as the sole manufacturer of the world. We have seen how the COVID issues as well as other political issues have resulted into people moving away from China, and India remains the largest potential market, manufacturing base, as well as domestic market to invest into, which is where companies like Apple have started manufacturing their latest iPhone this time in India. And we are seeing other such developments across various sectors. The other is obviously India still has a lower rate cap. We have only increased our interest rates by about 2.5%, whereas US from the bottom, for example, has increased their interest rates by about 5%. Clearly, there is a big gap, but the reason why we are able to do that is that our inflation has been relatively under control. We have been able to manage that much better than other countries in the world, and that also has made us much in a state of situation where we are able to grow much faster. Probably not look at a recessionary scenario. In terms of as we discussed, it's an outlier. We will probably see a capex cycle pick up from here on. And yes, domestic capital is now large enough, which is also a very important point, that today the fund sizes in the mutual fund industry, because of investors such as you, as well as in even the insurance industry, if you put together, is a much bigger size today compared to, and we are able to handle the vagaries of FDI, FII flows, which have actually resulted into much higher outflows, have been matched by equally high inflows from domestics. Key risks, yes, slower global growth is a reality. Monsoon, September will be important to watch out. Inflation also will be important because of things like oil coming back to $100 potentially, and then things like valuations as well as elections are the things that are important from a 2024 perspective. What we like, yes, we like cyclicals more than defensives. As we said, capex cycle picking up. Overall, multi-caps are seemingly better. While mid-caps are trading at a premium, there are opportunities across the board, even in small caps, as well as some of the high-quality mid-caps that one can look at. But obviously, large caps will continue to grow at a stable rate. So a mix of that, which is multi-cap, makes sense for us. So the sectors we are positive on: financials, consumer discretionary, including autos, industrials. We are relatively underweight on commodities-driven sectors, which are because of the slower global growth. So I think I'll stop here. I think we've covered a lot. Shikha, if you have any questions from your, over to you.
Thank you so much, Ashish. I think you covered broadly from India to global markets, valuations in the market, as well as the macros. There are a few questions I would like you to take. The very first thing is you said the mid-cap valuations are comparatively high here.
Mhm.
So, what will be your actions in the portfolio you hold, or what are your views on the mid-cap funds according?
Sure. So as we discussed, mid-cap valuations, we have seen many times in the past where for a while mid-cap valuations have held up higher than large caps, and the premiums have actually continuously grown more. This is actually a phenomenon where we are into an expansionary economic cycle where there are many more sectors that are growing faster. Probably a lot of small cap and new age companies in these sectors are growing faster and probably becoming mid caps and staying and showing much higher growth rates for a longer period of time. So these kind of scenario is what we are actually into right now, where the overall economy is growing. Part of the economy, which is investment and the non-consumption part of the economy, has started showing much higher growth rates, and as we call them as green shoots. That's where there are opportunities across sectors, and if these companies continue to grow for, let's say, from a 3 to 5 year perspective, and show visibility of growth, market will be ready to give them higher valuations for a longer period of time. Here, what I would also like to mention is opportunities that are driven by government policies such as PLI is actually resulting into many sectors that were traditionally not investable, such as defense, all the way to even textiles, chemicals, driven sectors, on the renewables, on semiconductor. These are all industries that were probably not existent as a big investment idea basket. Today, these are all come up, and a lot of these companies are actually in the mid cap space, and hence the valuation premium we are seeing there. So to that extent, yes, opportunities are there. But at the same time, there are many companies in this space who are driven by commodities where margins have grown and gone up much faster than they should. Probably will come down, because there are large cap companies in these sectors. If the growth slows down even slightly, the room for these companies to keep their margins higher will be difficult, and hence they can probably start slowing down. And that's where the overall basket of mid caps one needs to watch out, and that where the long term growth is visible, and where these are short term opportunities and need to be exited out of.
Thank you so much, Ashish. There are a lot of questions related to global market. I'll just make it a two-part question. The first thing is you said that global market is going through a slowdown phase, I think, which everyone is saying it. What our listeners want to hear that what are your thoughts on the companies which are actually focusing on the exports which are doing very well on the exports? So do you think they will get impacted or are getting impacted?
Sure.
Also, do you believe that it's a good time to invest in the global markets? And if you can highlight some pockets where one can invest.
Absolutely. Both are great questions. So first, just to come to looking at global markets, looking at companies that are able to export globally, I think India as an economy has not really seen the manufacturing phase of growth. If we look at our economy, we were largely agrarian-driven economy, maybe a large part of last century, and when we actually started developing, large part of our sectors that grew were consumption driven, or they were largely service driven. We did not see a huge scale manufacturing growth that probably an economy like China saw. And that's where we have the opportunity now for a lot of the industries and businesses in these sectors to grow. So, for example, our auto industry is about one-tenth in size compared to China. Our steel industry is about one-tenth in size to China, whereas our economy is actually less than one-fifth. So, to that extent, these are the gaps that one can start looking at filling. As well as what I mentioned earlier, the global economy and global industries are looking for, or MNCs are looking for alternatives to having other than China, which is where the big market that comes to mind from their perspective is India. The case in point being something like an Apple. This is where also the other part of the thread comes into play, which is the PLI policy that the government has clearly helps this sort of growth in two parts. One is obviously import substitution. So even basic industries such as chemicals today, we are largely dependent on China for a lot of our inputs. One would have seen this when the COVID crisis hit us. The pharma industry, while India was making a lot of pharma products for the world, including US, we were not able to procure the basic raw materials because of China being under lockdown. And that clearly showed that there is a lot of dependency that we need to get out of. There are various other sectors one can go on talking about, such as space, defense, electronics, where India is largely dependent on imports. Today, the imports of a lot of our electronic goods are so high that they are almost half the size of our crude imports. Clearly, these things need to be resorted and resolved. And that's where the opportunity also lies. So India is in two phase sort of looking at manufacturing. One is import substitution, making in India, and then making things, so which is where it comes as making for India, and then making it being part of the overall global economic supply chain. For example, the auto industry has been in India for the last 40 years. When Maruti started manufacturing in India, a lot of these auto component manufacturers are now at a stage where they are globally competitive, and they are starting to supply either largely made fully built components or part of that supply chain to various developed parts of the world. So to that extent, they have developed these technologies internally and are able to compete. So these are the opportunities that are there. Now, when we talk about slowdown in the world because of, let's say, high interest rates and recession, this is largely a cyclical phenomenon. We know that a recession and such things will probably be transitory, maybe a year or less than that is where such slowdowns happen. Then over time, we will start seeing that the rate cycle reverses. But the changes that we are seeing from India's perspective in terms of manufacturing are more structural, and a lot of these industries are growing from a much longer term perspective. Having said that, there will always be a lot of export driven, commodity driven sectors where any kind of hiccup in the world, let's say metals, for example, one can see a huge amount of volatility in the earnings of these businesses. And hence, one needs to be careful when we talk about global growth and exports that all of it is not going to grow. There will be parts which might grow relatively lower and probably see even losses. But there will be other parts which will continue to grow as these are more structural trends. Coming to your other question on which are the economy or which are the markets globally to look at, invest into. I think the funny part here is it still comes out that India looks much healthier from a global investment perspective. But if not India, I think the overall basket between developed versus emerging markets, I think at this point of time, emerging markets are a much better investment, have a much better investment case. A lot of the emerging market central banks have been ahead of the curve, which means they have not increased or have had to go into a monetary tightening cycle. Some of them are actually now talking about monetary easing, which means they will probably come out of slower growth scenario faster. And hence, probably there will be opportunities in these markets before one should probably look at investing in developed countries. Having said that, this is just a broader market comment. It does not mean that there are no opportunities to invest in US or Europe or let's say Japan, for example. In fact, we have seen Japan has been one of the best performing equity markets. So clearly there will be pockets of growth. The Nasdaq has shown a lot of decent bounce back from its lows from last year. So those are the opportunities that one should not miss out when we talk about investing in global markets. But as a basket, probably emerging markets should do better than developed markets.
So you said emerging markets will do better, and a lot of these emerging markets are looking for monetary easing. So, what are your thoughts on Indian interest rates, especially when food inflation is high? And do you feel it will come down soon? And what RBI actions will be on that?
Absolutely. So there are two-pronged approach here, which is obviously government is much more vigilant, as I mentioned, on the food inflation part of it. A lot of times, the right kind of measures, both on supply side as well as curbs or on exports, etc., or maybe allowing imports, etc., can smoothen these price moves. The other side, yes, I mean, at the end of the day, it is still in nature that rules the roast here. We are still dependent on many parts of the country are still dependent on rains. It's not a irrigation driven industry still, and to that extent we will have vagaries on food inflation. Having said that, as I mentioned, last 3-4 years we have seen decent amount of rainfall, which means reservoir levels are not at an alarmingly low rate. Hence this will probably be a more transitory phenomenon from that perspective. There are also global considerations here when we talk about food inflation, of what is happening in Europe right now, of curbs on various food exports, etc. But all of that, having said, we have been able to improve our yields as an economy, or as an agrarian economy, for the last 8 to 10 years. That has been a function of lot of improvements in technology, lot of improvement in agricultural practices. The government also putting in a lot of effort in terms of helping farmers with the right kind of information. So this is yes, this season might be bad, but as such, food inflation is not something that will structurally hit us for a long period of time. We will probably see, as we are seeing, reservoir levels are decent level. Probably for Rabi season should be decent, and hence that should take care of a lot of these issues. In general, high food inflation means that RBI will probably delay their rate cut. But for RBI, it will also be more important to see what happens globally. And more noise on Europe or on US side has been that they'll probably keep interest rates higher for a longer period of time, and that will actually dictate the policy on interest rates in India more than food inflation, which is more transitory.
Ashish, there are a lot of questions on our portfolios, and just sum them up and put it in a way that the outlook you have given, the sector positivity. So, what are the sectors you have already highlighted? But if you can sum up the sectors which you are positive on, and will they be part of the portfolio? Looking for that change in the portfolio, as well as how do you see people have been observing some cash levels have been reduced in the AMC portfolios. So, do you think it's the right time to deploy that cash, or how's the overall strategy working out?
Sure. So yes, I mean, there, as I said on the second part of your question, it is in various parts of the overall market have different level of opportunities, and hence that is determining the cash levels in those funds. For example, if there are large cap that is showing more opportunities, one would deploy more there, and maybe relatively lesser in mid caps, and similarly in small caps. To that extent, one will not probably see very high level of cash levels across our multi cap or funds which have more flexible level of capital, for example, hybrids, etc. That's where we'll probably see funds actually getting deployed in the right kind of stocks where the opportunities are there. The other part where you mentioned on which sectors we are positive on, as I mentioned as a brief, we are more positive today on cyclicals versus defensives, which means sectors such as financials, maybe slightly more tilt towards NBFCs, but also various banks that are showing decent level of growth, as well as resilience in their margins. Then coming to a few consumer discretionary sectors, especially autos as a sector which shows a promise of high level of growth that we have probably not seen in the last few years. There are various sectors that are also, as we said, new sectors that we have added in the overall industrials, capital goods, or manufacturing sectors, which include some of the auto ancillaries, but also move to chemicals, but also move to defense and various other sectors that have provided opportunities in the mid and small cap space that we have invested into. And probably a relatively, obviously, some of the defensives such as healthcare have been part of our portfolios. Maybe a shift from pharma to hospitals, etc., would have happened over a period of time, but we have a healthy mix there. IT as a sector has been relatively either underweight or equal weight for us, given where growth rates have probably been under question. The management guidance, etc., show that the growth rate probably will not pick up in the next 6 to 12 months. Other than that, I think market is showing that there are opportunities that are coming up time and again as newer and newer sectors come up. So we are extremely vigilant on that front. So for instance, even a sector such as power, which was probably looked at a very stable sector, has shown some spark, which with the level of deficit that we are seeing in that sector. So such kind of opportunities, while they might not be very long term, could also become investable from a few sectors perspective, for a few funds perspective.
Thank you so much, Ashish. And I think with that, we can wind up the call. We have covered more or less about the portfolios, about the market, and how we see things will move ahead from here. Thank you so much, everyone, for joining the call. Thank you.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.